Moving to Europe now, and the Federal Statistical Office, or the Status, reported that Germany's economy grew less than expected in the third quarter of 2024. Gross domestic product increased 0.1% compared to the previous quarter. Germany has narrowly avoided a recession this year, which is defined as 2 consecutive quarters of economic contraction. Household consumption saw a slight increase of 0.3%, while government spending rose by approximately 0.4%. However, exports of goods, a crucial component of Germany's economy, declined by around 2.4%. Eurozone business activity sharply declined in November, with the services sector joining manufacturing in contraction. The composite PMI dropped to 48.1, signalling the steepest decline since January. The unexpected contraction in business activity was primarily driven by a sharp decline in the services sector. The flash Eurozone Composite Purchasing Managers Index, the PMI, fell to 48.1 in November, down from the neutral 50 in October, marking the steepest decline since January and falling below market expectations for no change. The services sector, a vital component of the Eurozone economy, contracted for the first time in 10 months, with its PMI dropping to 49.2 from 51.6 in October. Meanwhile, manufacturing remained in a prolonged downturn, with its PMI falling further to 45.2, marking 20 consecutive months of declining production. US existing home sales surged 3.4% in October, reaching a seasonally adjusted annual rate of 3.96 million units, marking the first annual increase since mid-2021. This rebound followed a brief decline in mortgage rates, with sales rising 2.9% year over year. October's increase likely reflects contracts signed in August and September, when mortgage rates were lower ahead of anticipated Federal Reserve rate cuts. European Central Bank President Christine Lagarde has renewed her call for economic integration across Europe, arguing that intensifying global trade tensions and a growing technology gap with the United States create fresh urgency for action. She emphasized the need to integrate EU capital markets, noting that while progress has been made, national interests often dilute proposals. Lagarde pointed out that EU households are holding 11.5 trillion euros in cash, which could be redirected into long-term investments, potentially unlocking 350 billion euros annually. To facilitate this, Europe should reduce investment costs and ease regulations. She proposed a unified EU regulatory framework to simplify cross-border investments, but also stressed the need for more funding for innovative companies and startups in Europe.
While banks, play an essential role in the European economy, we know that integrated capital markets are needed for financing, in particular, early-stage breakthrough innovation. And it is key for becoming more resilient in a fragmenting world economy. Capital markets, in our view, is the missing link for Europeans to turn their high savings, more on that later, into greater wealth, which will ultimately enable them to spend more and strengthen internal demand.
Christine Lagarde there. Now, still in Europe, where EU trade ministers have met in Brussels to discuss the future of the European Union's trade policy, focusing on relations with the United States following the recent presidential election. Trump has hinted at imposing new tariffs, which could affect the two major trading partners. Despite this, European Union officials remained optimistic. Valdis Dombrovskis, European Trade Commissioner, emphasized the EU's commitment to constructive engagement with the United States and indicated that any potential tariffs would be carefully considered. A Polish official, Ignacy Niemczewski, stressed the importance of EU unity in presenting a cohesive stance to the United States administration.